When forming a partnership, it is hard to determine the taxable year end for the company because the partners may have a different fiscal year end, and using a calendar year may cause for excess tax deferral. So, Section 706 of the tax code gives 3 rules that helps alleviate these problems.
So Section 706B gives us 3 rules that must be followed in order. The first rule being majority partners, which states that if more than 50% of capital and profits are owned by partners who have the same taxable year, then use that tax year for the partnership. Similar to majority, the principal partner says that if all partners who own 5% or more of the profits and capital have the same tax year, then we use that tax year for the partnership.
The third and final rule is used only when the first 2 rules have failed. What you do is you calculate a weighted average for the tax years of each partner, and the tax year with the least weight is the tax year that the partnership will be using.
Team 7 Partnership has 3 partners, and they are SunTrust, Harvey Corp, and Connie. And the ownership percentages are as follows: 19% for Sherman Trust, 55% for Harvey Corp, and 26% for Connie.
Since Harvey Corp owns more than 50% of the partnership's capital and profits, then going back to that majority partnership rule, we would use the same fiscal year end as Harvey Corp, which is October 31st.
If October 31st is not an appropriate tax year for this partnership, the partnership can choose one of these 3 alternative tax years. One, they can have a business. They need to have upon the IRS's approval a business purpose for a different tax year, or they can choose a year for which it does not cause a deferral for more than 3 months, or they can elect a 52-week or 53-week fiscal tax year.
What would be a reason why our partnership would choose an alternative tax year over the original October 31st?